Welcome to Economic Trends, your source for the latest news and analysis on global economics and business. The latest K-Shiller index numbers are out, and they reveal that home prices across America have fallen for the sixth month in a row since reaching their peak last July. The values have gone straight down, falling a total of 4.4%. For many of you buyers watching this video, you may be thinking that a 4.4% decline is nothing, considering how far prices have gone up since 2020. However, this just isn't the crash that everyone has been predicting. To put this reality into perspective, let's run through a quick example. Let's say you were looking at a house at the start of 2020 that cost $300,000. This same house, using the K-Shiller index as a baseline, would have grown in value to $435,000 last summer. So even with the current decline in prices, we are still far from those pre-pandemic levels that everyone can remember. But there is good news, or bad, depending on which side you're on. While this decline seems like nothing, there is reliable evidence that paints a different story. You see, home price declines are very rare. Going back to 1987, there have only been 3 instances where we've had 6 straight months of declines. One was in the early 90s during the hidden crash, and the other was in 2008, which was the worst real estate decline since the Great Depression. Now, one thing most buyers simply don't understand is the pace at which real estate changes, whether that's up or down. While it may be frustrating to hear, things don't happen as they do in the movies. During the last crash, nearly 15 years ago, things fell apart over a period of years, not days or months. The K-Shiller index peaked in July of 2006 and then fell 32 months in a row before doing a bit of a waving pattern until February of 2012. At this point, it had been 5 years and 7 months since the start of the downturn. The whole crash was a very slow-moving train wreck. Just think about where you were 5 years and 7 months ago. That takes us back to August 2017. Now imagine, this whole time, prices were declining. This was 2008, and despite this extremely long period of diminishing values, the median price of a home in America only declined by about 27%. So, why do I say all that? Well, part of the reason is to set an expectation. If 2008 was the worst housing crash in modern American history, what can we realistically expect going forward? On this channel, I've gone over many pieces of evidence that show signs that this pattern will continue in the near future. But where will home prices end up? Even if my assumptions are true and we get another crash, to figure this out, I first created my own graph using FAT data that compares the 2008 downturn to the one that we're currently experiencing. Specifically, I went back 3 years prior to each peak and indexed the peak at 100. So you can see that the run-up to the peak was more extreme this time around. The numbers rapidly jumped up around March 2020. The important thing to notice about this chart is that as things stand today, we are worse off today than in 2008. That's not an exaggeration either. If we zoom in on the peak, you can see that the 6 months following July 2006, which was when the last crash started, we were down around 1.1%. In comparison, today, we find ourselves down 4.4%. So, what does all this mean for potential homebuyers? Well, it's important to approach the market with caution and a long-term perspective. If you're buying a home with the intention of living in it for the next few years, it's important to remember that real estate values can fluctuate and that the market can be unpredictable. That being said, it's also important to remember that real estate is a tangible asset, and historically, it has been a solid investment over the long term. If you're able to buy a property at a good price and hold on to it for several years, it's likely that you'll see a return on your investment. Of course, there are many factors that can impact real estate values, and no one can predict with certainty what will happen in the future. However, by staying informed about the latest trends and working with a knowledgeable real estate agent, you can make informed decisions about buying or selling property in today's market. The real estate market, it's a complex and dynamic system that can be difficult to understand, especially with all the different indicators out there. One of the most well-known measures is the K-Shiller index, but there are a few things you should know about it before making any judgments. First, the K-Shiller index is a lagging indicator, meaning it doesn't really reflect what's happening in the market right now. For example, The latest report is from December, but we're already in March. So the data we're seeing is from home sales in October, November, and December. And even then, the data might not be entirely accurate because it takes a 3-month average, which can mask any sudden changes in the market. Furthermore, the index doesn't take into account external factors that might impact the market. For example, in late August of last year, interest rates exploded to extremes, putting a massive burden on the market and likely contributing to prices falling in the following months. Since then, rates have relaxed a bit, but the trend is still downward. Speaking of trends, it's worth noting that the old narrative of low inventory levels preventing prices from dropping is collapsing before our eyes. We've seen that prices don't decline until inventory reaches 6 months of supply. But in 2022, we're seeing collapsing prices despite inventory being nearly 3 months of supply. This is a clear outlier that shows you don't really need inventory for prices to drop. So, where does that leave us? Well, if prices keep declining at record numbers, the big question is, how low can we go? The worst crash in recent history, the 2008 crash, had a peak-to-bottom decline of 27%, which is a significant drop. If we assume that the next crash will see prices decline by 22%, about 5% less than the last crash, then a $400,000 home would become a $309,000 home. But don't get too excited about the prospects of affordable housing just yet. That's because interest rates play a significant role in determining the real cost of a home. About 75% of all homes are bought using a mortgage, which means that discussing the price you pay for a home is only part of the equation. Realistically, most Americans should focus on their monthly payment because it's the price that really affects how much you're willing to pay to live in a certain home. During 2020, home affordability was close to record lows, with the average monthly payment for an American buying a house being around $1,200. But since then, that average payment has jumped to $2,486, which is more than double the 2020 amount. So while home prices have technically risen 38% in that same time period, monthly payments have gone up by 100%, and it's unlikely that things will get better anytime soon. Predicting interest rates in the future is close to impossible, but given the current inflation data, it's very unlikely that we're going to get under 5% on a 30-year mortgage anytime soon. Even if rates do come back down to that level, it would still take a massive, historic crash to bring monthly payments back in line with 2020. In conclusion, the real estate market is a complex and dynamic system that is affected by a variety of factors, including interest rates, inventory levels, and external events. While the K-Shiller index is a useful tool for measuring price trends, it's important to remember that it's a lagging indicator and doesn't reflect the current state of the market. And even if prices do decline significantly, the real cost of a home is determined by the monthly. Be sure to subscribe and enable notifications to view future information about global economics and business. Until next time,